Hello everyone and welcome to this session today, focus on connected insurance as part of the Canopy Roundtable series. My name is Rita Yates. I'm the CEO of Insurtech Australia. We're a not-for-profit member-based organisation representing the insurtech industry across Australia. We have the mission of building a world-leading insurtech and insurance innovation ecosystem right here in Australia. And of course, Canopy is one of our member organisations. So I'd like to thank Nigel for inviting me to chair the roundtable today and to the participants and attendees for joining us. So what is connected insurance? Essentially, it can also be referred to as real-time, dynamic or on-demand insurance, and I'm sure you've heard a lot of these terms before thrown around. It's insurance that's connected into internet-connected devices and other platforms that hold data, such as accounting software platforms or fintechs and proptechs, which enables these types of businesses to also offer insurance. These platforms are often referred to as ecosystem partners, also terminology which I'm sure you have come across before. So from a consumer's perspective, if we use the example of a small business insurer, they can buy a policy from their accounting platform, and this policy would change dynamically with their needs as their platform detects changes in their business. Another very common example, which is often used globally as well, is on-demand car insurance, where users can purchase cover based on how and when they use their car. So what's particularly interesting, and certainly interesting for me, is that this data-driven, digital and connected approach is changing the landscape for insurers, creating some great opportunities for them as well as their ecosystem partners, but also great opportunities for insurance technology firms to build these solutions. So we are going to start the discussion now, and I will introduce our first speaker for today. So our first speaker is James Orchard, who is the CEO of QBE Ventures. So James, I might actually ask you just to touch on what QBE Ventures does, but also I'd love you just to share with us where your interest in connected insurance lies and where it stems from, and in particular from the perspective of a major insurer.
Yeah, sure. Thanks, Rita. Hi, everyone. So as Rita said, I'm James Orchard. I'm the CEO of QBE Ventures. So QBE Ventures is the venture investment and development arm of QBE. So we're really focused on bringing the outside into QBE for the purposes of really trying to accelerate our long-term strategy. So we really see connected insurance as being a real driver, if you like, of business model innovation into the future. So really it really is the linchpin, we think, of how insurance is going to change and the whole value chain. So from distribution to pricing and underwriting to claims management, it really does open up so many doors. So from a ventures interest, we're really trying to look out a few years to really sort of understand, well, what are the trends, what are the capabilities required to understand and bring connected insurance in? How can we start to raise awareness of this within our business and educate the broader QBE organization? How can we start to pilot and undertake proof of concepts in this space? How can we start to have a look at new partnerships that can help us do this? Right. So it's a massive interest for us. It's a real part of what we're looking at, and something that I think that as we start to understand, as the industry starts to understand, and they start to scale, is really going to change, how an incumbent insurer like us does business, not just for personal lines, but right up to the complex lines as well.
Thanks, James. We might move over to our second speaker for a perspective, Simon. Simon O'Dell is the Managing Director of Insurtech Gateway in Australia. Simon, you might want to touch on what Insurtech Gateway does, but also just talk a little bit about where your interest in connected insurance lies and stems from as well.
Yeah, no worries. Thank you, Rita. So yeah, Insurtech Gateway Australia, we're an incubator of early stage Insurtech startups, and we're an investor in those startups as well. So yeah, we provide access to our license, so regulatory permissions, and access to a venture building platform and partners like QBE and others, other progressive insurers who are willing to roll out their pilot and partnership programs and so on to help these early stage startups get into market. So similar to James, our connection with connected insurance, or our interest in connected insurance, lies in that we're in the market looking for the best disruptive Insurtech startups. We see hundreds of pitches per year, and it's very much fundamental to a compelling and exciting Insurtech startup, the connected insurance. So usually a compelling and exciting Insurtech startup, in other words, has connected insurance at their core. We see different versions and representations of connected insurance through different startups and the way that they're looking to add value throughout the value chain, as James mentioned. We see lots of really good examples of that, and some of those are in our portfolio.
Perfect. Thanks, Simon. And we'll move now to our third speaker, Nigel Fellows-Freeman, who is the founder and the CEO of Canopy. So Nigel, you might want to start just by telling us a little bit about Canopy and then moving into, I guess, your focus and your interest levels around connected insurance.
Yeah, of course. Thanks, Rita. Hello, everyone. Appreciate your time. I guess thinking about Canopy specifically, Canopy is a data-driven platform that maybe kind of provides insurers with kind of the modular technology that they need to transform their legacy architecture and infrastructure to deliver that kind of connected ecosystem-led approach. And so when you think about their current legacy tech, how can they evolve that with their current ecosystem partners? And then how can they think about building, launching, and scaling kind of new ecosystem approaches in a very kind of fast, flexible, and adaptable way? And we built a platform that kind of enables that. And so therefore, like, connected insurance for us really sits kind of fundamentally at the core of what we do. And so James touched on something really interesting around kind of trying to look forwards, and kind of when we think to kind of what does 2030 look like, and there's the potential for almost 25% of kind of all services, total economy, to be via a connected approach versus kind of maybe 1 or 2% today. And so we think that kind of very fundamental change is happening and is in the future. And we've seen it in a really small microcosm during the pandemic. There was some kind of research came out from McKinsey just earlier this year that I think just over 70% of customers now are saying that they are willing to transact and kind of do business within integrated ecosystems. So it's really starting to accelerate that process. And then when you think about insurance, fundamentally, it's a data business. And so I think it makes a bunch of sense that insurance is a primary use case for this connected world. And kind of that's what we think a lot about. And that's what we're trying to do in terms of build a platform to enable it.
Thanks, Nigel. And I guess that focus around consumers and what they're wanting into the future sort of leads me in quite nicely to my next question, which is actually around where you see the benefits. And each of you have kind of touched on that, in particular, talking about the business models of the future around insurance. But perhaps if we can delve a little bit deeper into, and I'll start with you, James, what you see as the main benefits of connected insurance, in particular for insurers, but as also their customers.
Yeah, so I'll take our perspective first. So building on what Nigel said, I mean, connected insurance is really centered around data, right? And being able to use data more intelligently. And I think that's something, certainly incumbent insurers haven't done well and don't continue to do well at this stage. They're starting, but there's a long sort of journey ahead. So it really is about taking that and being able to generate new insight, learn new things about our customers, learn how they want to transact, what's relevant for them, what's not relevant for them. How can we segment our customers into not just a very traditional way insurance companies segment them, which is, are you willing to pay a high premium or are you willing to pay a low premium? Do you want to transact through a branch or do you want to transact online? It actually allows us to go much deeper into the behaviors of the customer, for example, and really then come up with a product and an offer and a price that's available through the channel that they want to transact in, and really allows us to, over time, start to move to what we sort of call one-to-one pricing, right? Which is far less about pooling and aggregating risk and sort of coming up with sort of an average. It's really about understanding the specific needs of each customer and then being able to really sort of service them, right? So that's where we get into the benefit of the customer. You start to move away from having to proactively find the right insurance product, transact, and the transaction is limited simply to transferring your risk. It's then moved to a much more convenient experience through the channel of your choice. So building again what you said before, really around say like accounting software packages for small business. If we sort of branch into that a little bit later, I won't take any Nigel's thunder because I know he's probably going to talk about that a lot, but it really does allow you to understand a lot more about a small business, right? And so if you can start to do things with that learning, bring it back in, offer something that's more relevant, then the customer feels as if they're better understood. They're getting a better, more fit for purpose product. You then start to close things like the underinsurance, an element of underinsurance. You start to potentially close affordability gaps. You start to do a lot more with that. So I think it really does center on the customer, on the insurer being able to sort of understand that and make way for that and use that and ultimately deliver something that's better for the customer.
Thanks, James. And I think we can probably all safely say that in the insurance industry, that's not an area that has been done particularly well to date, and there's plenty of room for improvement, let's put it that way. Simon, perhaps we'll move to you now and just talk a little bit about the benefits that you see from your perspective, and perhaps you can even extend it to the broader insurance ecosystem.
Yeah, sure. Yeah, I completely agree with James. The way that I look at the way he described the underwriting and the traditional way of underwriting, I think it was about 400 years ago, the 17th century, when we went from pricing or providing a price for a product, a uniform price for everyone, to dicing up the population into chunks. So it used to be such that it'd be the same premium for life insurance whether you were 7 years old or 70 years old. And then we moved through when we started to use data and probability theory to be able to say, okay, well, we can divide the population into chunks. That was 400 years ago. For example, age, sex, and things like that as a proxy for risk. And it's interesting that many of the insurers stood up around then, seeing that as a competitive advantage to be able to come in and underwrite in a more granular way, are still around today. And I see, I don't want to be overly dramatic, but I kind of see the events happening now as almost a 1 in 400 year event, in that there's a marked shift in our capability to be able to move from rather large chunks and analysing those large cohorts, as James termed it, more one-to-one pricing, where we can actually go from large chunks to pricing for an actual individual, not, for example, me as a male, my risk as a driver is that of the average of a male plus the average of my postcode plus the average of other cohorts that it's chunked into, whereas connected devices and connected insurance is opening the opportunity for insurers to basically execute on data science. There's more data that they can want at the moment through connected devices and so on. So what's their data science capability to be able to price me based on my risk individually? So underwriting is the main area that I see as a benefit of connected insurance. And that's probably one of the areas that I'm most excited about, I guess.
Great, thanks, Simon. And moving to you, Nigel, now, and where you see some of the main benefits and touching on either insurers, digital platforms, but also, of course, customers from your perspective.
Yeah, I think James and Simon done a great job in just highlighting. I think there's I saw something come out of one of the large consulting firms over the year. I think it's the expected. I think it's 1 trillion connected devices by 2025. I think kind of on current estimates. And so if you think about that, obviously what Simon and James just mentioned around the volume of data that creates, I think the challenge and the opportunity is then it's having the data is only one thing, and then being able to use it really intelligently in a connected way to deliver a kind of innovative service is the challenge, but also the opportunity, and will deliver the value to the customer and that kind of N equals one experience. And so, how can you make all of us on the call here all have a different customer experience, have a different pricing experience? I know James talked a little bit about connected cars, and I know you kind of jump in, you plug your journey into your map, and you've got, based on taking 3 different routes, you're going to get a different underwriting price on the 3 different routes based on what the risk is for that route and your driving experience. And so you can get really granular, I think, as well as predictive, not just kind of retrospectively, then predictive pricing based on kind of things that are going to happen. So I think that underwriting is something really important on the underwriter. And I suppose just to build on that carrier piece a little bit, I think price will always kind of be pretty core and fundamental to a consumer. I think that's always going to be important to them. But I think what kind of connected insurance does allow the carriers to maybe diminish the reliance on price as a competitive advantage, and really kind of take the consumer and the carrier more towards kind of value proposition, different experience, kind of different behaviors. So I think that's really kind of where the competitive advantage can come. Even though price will still stay fundamental, how can you change the proposition to the customer based on the new experiences that you can give them?
I think that's to build on that, because I think we're starting to see now a lot of incumbents globally, right? Incumbent insurers, that is, start to have a look at taking a more ecosystem approach, as we sort of call it, to some of these segments. So building on what Nigel said, so one of the, and we're not too dissimilar from that. We're thinking about that in markets where we have a good market share or a strong domain expertise. You're starting to have a think about, well, the benefits of connected insurance and understanding the data and being able to incorporate that to offer what we've just talked about, that will come over time. How can we then, if that's where the industry is moving, the ability to build something that's differentiated in market, that challenge still exists, right? So one of the key things that we're looking at is how you can look at value-added services in addition to the risk transfer, right? So how can you start to use partnerships in a different way? How can you start to be able to offer other services that customers, would be comfortable that an insurance company providing, or a series of partners that are connected to an insurance company provide, right? So as an example, let's pick something like construction. Okay, so you're looking at a complex line of commercial insurance. You're starting to see a number of insurers now. I mean, AXA are doing a great job in Europe of starting to build out this construction ecosystem. So everything from small things like being able to provide sort of weather-related information to a site, right, so that they can plan ahead, to various other sorts of software to project manage or understand the safety of the workforce on site, all these sorts of things. You can probably go down to logistics and sort of all these other services that, if you're an AXA customer in that product, then you start to benefit from all these services too. So I do think one of the other benefits that we sort of haven't touched on yet from the customer is that all of a sudden it's not just around the right product at the right price, it's around all these other services that they might be able to get that they haven't otherwise got. And over time, that will then be able to sort of inform or improve their behavior. Say, for example, risk management around a work site, which is where we're at with MITI. So really having a look at those sorts of things and then being able to sort of piece that into the proposition, I think that's a big benefit we sometimes sort of miss as well.
That's a strong part of our investment thesis, is looking at MGA models, so managing agents who can not just create new data to create risk awareness, but provide the tools and the levers for the owner of the risk to be able to put downward pressure on risk as measured by the frequency and the severity of losses. So audit cover is one example of that, whereby they don't just provide risk transfer options for the consumer to protect themselves against unforeseen professional fees from an ATO tax audit, but they also provide a data analytics widget for the accountants, so that when at the point of the risk being incurred or just prior thereto, they're able to look at the profile of a lodgement and understand the risk profile, and then change that profile so it's a lower risk to bring in a claim or bringing rise to a claim. So that's one simple example, and there's more interesting examples out there. But yeah, we definitely see that as part of our thesis as well, recognising that that's a way of the future.
So I was going to say almost exactly the same thing, Simon. Just that fundamental shift from product to service is like on a macro of all of those things, right? In terms of rather than taking a once a year single purchased annual renewal type approach for insurance, to then kind of moving more towards a continual purchase journey and interaction journey through the year based on kind of data points and kind of risk mitigation for the customer, to prevent the risk happening in the first place, not just kind of cover the loss, but to how can you actually think about protecting the risk in the first place. And obviously that helps from a loss ratio perspective from a carrier, but also obviously the customer never wants to kind of incur the risk anyway. And so I think that continuous cycle away from single annular policy is like this, sits underneath all of that.
Thanks, all. Some really great insights there. And I think, certainly what we can see globally is this move more towards the predict and protect model of insurance, and acting as a true partner to those that you are insuring, whether it's an individual or a small business, as opposed to a transactional product type of approach, which is a much more traditional insurance approach. So I think everything that you've just talked about there really fits much more into that value-added predict and protect model for those that are being insured. And I think that's where insurers have such a huge opportunity to really change the way that individuals and businesses actually think about insurance, which tends to still be on the more negative side, as opposed to that partner side actually trying to help and support them, which is what insurance is for at the end of the day. So great insights there. So I guess we've talked a lot about some of the positives and the opportunities, but of course we know that with any new form of technology adoption, there are certain risks and challenges. So maybe again, starting with you, James, maybe if you could outline, particularly for insurers, what you see as some of those major risks and challenges.
Yeah, thanks. I'll start with the challenges, and this is sort of this isn't anything say unique to QBE. This is certainly something that the industry is grappling with broadly, and any large organisation grapples with, is that something like connected insurance, and sort of as we progress that more to business model innovation, that's a significant change to how a large company and a large industry operates, right? And so it's not just a simple project to be able to roll that out. If you're going to do it well at scale, you need to, it's a large change piece that's going to happen over time, and it's going to take many learnings, right? So, a lot of people are getting it wrong, and you sort of pivot and go many different directions and open yourselves up more to a lot more partnerships and digital platforms, ecosystems, etc. So I think where I'm getting at is that any change like that, it takes time and it takes resilience. So internally, for a ventures perspective, part of our role is not only to find the right startups, the best startups in the organization, and work with them with the broader organization, but it's also about really trying to understand where the business is at, what are their strategic priorities, and then I guess sit in the middle somewhat and connect the dots between the large company, large organization, and the startup. I mean, they're both inherently reliant on each other for success. They both want to innovate. They want different things, but sometimes bringing them together it can be a real challenge, right? And so that's really part of our role. And so you do get a lot of pushback, right? You do get a lot of you have difficult conversations around the fact that change costs money. It takes time. Sometimes it's a distraction from the core business. You've really got to have the business thinking about sort of the longer term, so 5 to 10 plus years into the future. And as we know, in any large corporate, that's not always easy. I'm really pleased to say at QBE though, the future is looking really bright in the sense of how we're starting to consider these things and start to work with startups. But that is an underlying challenge, I think, that we really have to sort of lean into. On the risks things, I think the biggest one to call out, which is an obvious one, is that you're starting to deal with a lot more data, right? So you need to have the infrastructure, the protections, the securities in place. You need to really sort of focus on building that trust with customers. Now, as I said, insurers actually do have a lot of trust with customers, but when something goes wrong, you sort of can erode that trust quite quickly. So you need to really sort of be on the front foot around all the necessary governances and protections in place, and really sort of focus on building that trust piece. I think the biggest risk we honestly have is not doing anything at all. That's probably the biggest risk, if I'm honest. But yeah, coming back, I think it's really around sort of business model innovation and getting the business to really think about it's not just a technology project on the side, right? It's really having a look at the end to end. How can you do that? How can you move forward in a really good way? I mean, when we built MITI with safety culture, we had to spin that out, right, to get around some of those, I guess, more onerous requirements if you were to build it inside. So by spinning it out and creating that JV with safety culture, we managed to, the business managed to free themselves up from a lot of those encumbrances and allowed to move a lot quicker and get something into market a lot faster at a pace that safety culture and the MIDI team were used to moving at. So that's one way we can overcome that challenge. But I think over time, businesses are really going to have to lean into that and make sure they have the right process and the right governance internally to be able to experiment properly and start to play with things like connected insurance.
Yeah, and I'd build on that and but what we've seen from the outside in terms of working with insurers. I think there's two things that we kind of see externally as the key risks in terms of kind of young companies working with large insurers and in looking at like understanding what the future might look like. And I think they sit in both technology and people, actually. I think on the technology side, I think James is right. The not doing anything at all is probably like primary risk number one. But then second, that sits pretty closely behind that is I think there's always a wanton desire with large incumbents to build and not partner. And I think that can, as soon as kind of you go down that path, I think the speed that an incumbent can move and deliver new products into market and not having the right technology stack and the infrastructure to be able to do that, I think means that you'll miss opportunities and not be able to take advantage of opportunities and be much more scared of failure, I suppose. And so that's kind of on the technology side. And then I think on the people side, and maybe obviously James is bringing that kind of those kind of people into the organization, but more traditional folks within insurance organizations maybe aren't as technology adept as they should be, and creative, willing to try new business models and try new processes. And so I think the thing that incumbents will need to do and carriers need to do is to bring kind of new kind of people into the businesses that have maybe a different outlook. And I think ventures is obviously a key way to be maybe a conduit between those two pieces. So I think it makes a bunch of sense.
Yeah, it's always going to be difficult for, it's inherently difficult for an incumbent to partner with a startup. It's just a matter of what's the best way to partner. But for example, a startup they'll go to the VCs and they'll pitch their total addressable markets, the universe, and they want to conquer the world. And yet, an insurer ain't partnering with a startup wants to get a competitive advantage to be able to in a marketplace, a finite marketplace or whatever. But there is definitely a way to do that properly, and it's nice to see some examples of that. And Nigel, you've obviously been really successful at that, and so is QBE, which is really nice. But it's inherently challenging. But it's just a matter of finding the best way to navigate those challenges. One of the risks that I thought would be noteworthy to mention is that for every part that you expose risks on a more granular level, you are exposing an uninsurable class to a degree. For example, greater bushfire risk modelling might allow some public assets to be insured that are out in the forest, because all of a sudden you can actually understand what the risk profile looks like, so you can start to underwrite that risk, which is great. It brings in assets that were previously uninsurable online into the insurance pool, and that all helps. But there's also the ones that are really high risk and the insurers will just pass on. And we've got Far North Queensland as an example of that. You almost need a public-backed insurance kind of scheme where they've got this public reinsurance pool where they're helping out to be able to overcome that. But again, I guess it comes back to what we discussed earlier, which is at least with risk awareness, even if it is moderate to high risk, it puts the onus on the asset owner to be able to improve the profile of that risk and to mitigate, rather than traditionally it was, well, I'm just a part of a chunk which is this postcode and I'll just get absorbed. I'm a bad risk, and the lower risk who are paying premiums cross subsidise, but I'll get the claim payment. So I guess it's forcing people to be able to have to look at their risk, if they're moderate to high risk, and treating that and making sure that they're managing that risk profile.
Super interesting, that, Simon, isn't it? Because so I completely agree, like kind of pushing it into the insured, but the reality of like Sally sitting at home thinking about her like wanting to reduce her risk profile, to reduce her premium, like it's how do you kind of bring that to the real world? Like how do you kind of motivate that person that's in a and educate them in a way that's kind of engaging, that kind of gives them the proactive information that they need to help them do that in a really intuitive, simple way, rather than kind of making it kind of very kind of insurance heavy, which obviously I think will push people away. And so I think you're right, that the thematics there, and it's how do you kind of make that accessible for those people to understand that, how's that tangible to them?
Yeah, good call.
And I think that's one thing that's been really interesting when we've seen some, globally, some niche propositions pop up, whether it's be from an incumbent perspective or from a startup sort of MGA perspective. It's really interesting because I think, Nigel, you nailed it. Like that's a key point, right? You want to build a relationship with a customer. You have to be able to add value. You need to sort of, I guess, try to shift that risk management or that behavior over time so that you can sort of educate the customer and make them a better risk, right? And I think a lot of the times, these niche propositions, they rely heavily on a technology play. So they sort of lead with the technology, and there might be sort of promises, but in the end, what you've got to do is sort of create that sustainable engagement, that frequent engagement with customers. And it needs to be around something more than just, technology, right? It needs to be something more than something that can become gimmicky or, as a free device with cheap premium for a little while. What you really want to do is address some of these higher order problems, I think, through the value proposition and come back to that building trust over time. And that's where you can really sort of start to deliver value through, connected insurance proposition and build that over time. I think the first wave, if you like, of innovation in this Insurtech space probably overemphasized, in my view, it's my personal view, overemphasized more the technology or the gimmick or, the fad, right? And quite quickly that sort of, I guess, can lose appeal or sort of fades away. I think one of the bigger things is really to really concentrate on that value proposition over time and those higher order needs. I think so. Safety is one, for example. So really, how can you drive that?
Yeah. There was definitely a sobering event after the record investment funding from VCs in 2015. But yeah, it's obviously skyrocketed since then. I'd agree. There's definitely a sense of that. In saying that, I think technology, obviously we all agree, technology's got a significant role to play. And where the rubber hits the road, it's a really good call. Like one of our portfolio companies, GLO Carter, they're creating a digital twin of our physical environment. So it's as high a fidelity as one can achieve in terms of a digital representation of the reality that we experience outside every day. And it's very frequently updated. So what that's doing is, I guess, providing an opportunity for insurers to, in a cost-effective way, be able to gain insights on the risk exposures that their customers have and potentially package that up as a service to the consumers. For example, we noticed that a branch from your tree in your backyard fell down last week. We're going to have a contractor come out and clean that up for you. It's a liability risk, or it could break your fence or whatever, or whatever it might be. But certainly having a digital representation of our physical environment built into insurers' workflows that they can experience at a desktop, that efficiency gain, I think, will be really helpful and open the door to allow insurers to use their creativity to package up a myriad of services on that.
Yeah, some really interesting perspectives there, and I think You've each mentioned partnerships at some point, so I kind of wanted to move to that a little bit now. And we know that in the Insurtech ecosystem, we talk a lot about partnerships and really see that as part of the future of insurance, both here and globally. So I guess for digital businesses and insurers, some areas I'd love to sort of draw out some areas where we think working together can be made easier to offer connected services.
When you think about partnerships, how can digital businesses and insurers like create kind of more cohesive partnerships? And I think for me, I think there's kind of two really important parts. And the first one is, James mentioned it a little bit earlier on, which is it's a really complex thing, and kind of carriers are really complex organizations, and every business unit has different kind of wants and desires and has different P&Ls, and so kind of building partnerships is a long kind of trust-based exercise that I think needs a really kind of cohesive core strategy that then kind of everything can work from. So I think that's kind of number one, from our view. And the second part is, I think kind of partnering early and actively is important. And so I think if you can partner early and actively, that'll help kind of develop and fine tune those offerings over time. I think it will shorten the time to market, to learn and to fail, and to get things and then when something works, to be able to kind of go chips in and scale stuff up. And so I think kind of sometimes the leaning can be to wait and try and find the perfect proposition, but I think sometimes it's a little bit better to kind of partner early and then actively develop the partnership, because that builds trust over time, and then that's going to allow for different kind of services to crop up, and for that relationship to deepen over a period of time. And so kind of that's my thinking on those kind of 2 points. Maybe I'll hand over to Simon or James to go from there.
Yeah, I think I completely agree, and I think a couple of things to add. I think so. So from an incumbent perspective, I mean, obviously spent a bit of time doing this now, and had the opportunity to reflect a little bit on, what partnerships have worked well and just what ones haven't worked well. And I think, Noda, you started to touch it there. I think the first thing you need really is that clear strategy, right? I think going to explore partnerships without an internal, and this is from an incumbent perspective, without an internal clear strategy, right? So there's always going to be, sort of thought leadership, sort of market understanding, sort of competitor analysis pieces, right? Which is really just a learning exercise. But I think if you're moving those conversations much more and the networking much more to the partnership piece, I think you've really got to have a clear strategy internally as to why you want to partner. So, for example, all the times when we do work, we'll start with a sort of discovery phase internally, which is all about, I guess, really truly understanding the problem that we have, understanding what solutions we think might work, and starting to test them. And then sort of when we get through that piece, during that, obviously, we get a pretty clear understanding of what the market looks like and who the partners out there. We sort of start engaging, and then when you sort of find the right partner, you've done that work up front, right? So you've got internal sponsorship, you've got support. That could be funding as well. Obviously, venture sort of comes into a bit of that as well if there's investment. But you do that homework up front, right? As I said, then you come in early, right? And so you're coming to the piece with a lot more of the internals done. It removes a lot of the ambiguity sometimes for the team working on that, and allows you to move a lot faster. Now, that's not always possible, right? But it certainly allows you to start from the best position and really sort of have that clear strategy. I think the second thing too, from an incumbent perspective, and this isn't all in the venturing space, is that I think there needs to be a recognition. I'm certainly seeing that partnerships are different these days. Like it's not just about putting your product online and then having a partnership where there's a white labeled website or you do something like that, right? There's a lot more to it than that. And I think as such, you need a different sort of capability at the forefront of partnering within a large incumbent, right? So we're seeing partnership teams now not just have sort of BDMs or sales and partnering folks to sort of do the negotiation, but they have solution architects on the technology front. Right? They have data scientists, right, to be able to sort of do piling, understand sort of data infrastructure and security needs. They have cybersecurity. They've got access to or have their own resources that allow them to really sort of broaden their capabilities and to understand the partner, right? So I think a recognition that partnerships are changing, and if any incumbent wants to go out there and find the best partner to work with, they're going to have to come armed with a lot more than a sort of a free lunch for the partner, right? So I think that's one of the big things. And then the final thing, which really sort of echoes your point around starting early, is I think clear communications. I think on both sides, like the incumbent needs to recognize that they need to move a hell of a lot quicker. They need to really have their house in order, and they need to be prepared to sort of test and learn, etc. I think on the startup side, you need to recognize that you're dealing, as you mentioned, with a large monolithic organization at times. Things change. You need to be resilient. Both parties need to be disciplined. But most important, I think all of that will breed trust, and all of that is sort of going to be underpinned by a clear communication strategy. So if there's delays, if there's a shift in strategy, if there's something you need to be told, if your technology, has got a couple of bugs in it and there's a backlog, then we need to be told. And so these things where you can just sort of manage both the sort of the tactical, but also the strategic piece, and have clear comms. I think that's just something that I've really noticed. If you have that, the partnership is just so much more fruitful.
Yeah, good call. Yeah, part of the reason we exist, or we do exist, because the barriers to entry for startups are high. And one of the biggest barriers is finding and arranging, if I can use that word, the right partnership with an incumbent. It can be very challenging, and it needs to be done right. There's a certain way to do it, and there's many ways not to do it. It's quite challenging to do it, and I echo everything that you said just there, James, really resonates with myself. I think that both the insurance industry, all the APRA regulated insurers, and the startups that we've worked with all recognise that there's a lot of nuance that's needed in nurturing that type of relationship. And a lot of it for us, in terms of how we work with our portfolio companies to make partnerships happen, is there's many ways to de-risk the partnership. We frame it up as de-risking it, because at the end of the day, the insurer looks at it often through that lens, is my understanding. And that can be, especially post-Hayne Royal Commission, it's obviously a very interesting environment around regulation and so on. So we encourage the portfolio companies and facilitate a way to be able to have a third-party independent compliance consultant come in and do a review of the whole sales journey and provide a report, like an exceptions report, and say, this is where the risks are, this is how it will be managed. And also, I hate using the cliche, a genuine partnership, but at the end of the day, it needs to be a genuine partnership where the MGA and the head of insurance is willing to slowly build up the growth and have that controlled growth. So yes, we're happy to limit the limit of liability. We're happy to manually underwrite for these certain things to begin with, as we build confidence and use the risk metrics as the proxy for how well we're doing and the confidence that we should be gaining. So yeah, there's a lot of things that can be done. We're happy as an independent to come in and see what's going on both sides and help provide that kind of pathway to help de-risk that for both parties, I guess.
Yeah, one of the things we think about, just building on that, you raised a good point actually, is jogged a memory, is one of the questions we often get asked is why make an investment? So you might have a partnership already in place and everything might be fantastic, but why make the investment if you've already achieved that? So, and one of the things we really look at is, as we are a strategic investor, so we want to invest for the purpose of driving much greater benefits for our organization rather than just making a financial return. Is you start to shift the partnership from a tactical provision of service to something that's a lot more ingrained, in the sense of you're building, you're co-creating, you're building joint roadmaps for the future. You're really sort of both parties are bringing IP to the table a lot more and starting to have a think about solving problems that stretch far beyond just that provision of service. And I think that's one of the beauties of having a venturing capability. I think that allows you to sort of bring that investment into the game, right? You can then completely change the dialogue between both organizations. Say, yes, we're happy to pay this rate and consume this service. That's great. And we understand that's what you want. You want to scale your business. But have you thought about applying your technology to solve this, this, and this? Because we can help you with that, and that can help both organizations, right? And so I definitely think there's a need, sort of building on my point earlier around partnerships, to also recognize that sometimes you can have an engagement with a partner that allows you to think about things more strategically as opposed to just that provision of service.
Yeah, good call.
Yeah, great, really great points there to finish up that question. I just wanted to let the audience know that we are going to start question time soon. So have a think about what questions you might have, and I can see a bunch coming through, which is great. And just follow the instructions on your invite to move through to question time. The producer is going to open the audio one by one in about 10 minutes or so. So if you can have those ready to go. But just before we do that, I kind of wanted to bring the conversation to life a little bit, just in relation to some case studies, and ask each of you if you know of any companies who are doing connected insurance really brilliantly, and perhaps if you do, what can be learnt from them, and what area do you think is currently still unexplored and potentially ripe for some opportunity there?
I'm happy to jump in if you like. So when I think about doing well, I think about the performance metrics that we put in place to define what doing well looks like, and often that's growth, but also managing the bottom line, so the risk metrics for the insurer and that as well. So there's the Lemonades and the Hippos and the Metro Miles of the world, and dare I mention names, but like their risk metrics are not that amazing. Like they're growing and just using investment capital and muscling their way into the market, I guess. And yeah, they're growing at quite rapid rates, and they probably will for a while they burn VC capital until they start to plateau into normal growth rates. But yeah, in the meantime, they're kind of running at significant net losses. Well, I guess doing well are the MGAs that do have certain levels of innovation that are similar to those companies, but also are doing it in a way that's more sustainable. They're not diluting as much equity for the founders, so they don't need to burn through all that venture capital. So examples of that is companies like Buy Miles, we've set up Cobra locally under the same type of ethos, I guess, for pay per mile / kilometre car insurance. So they seem to be doing well. They've, in Buy Miles, for example, just to provide a data point to evidence that the average claims frequency is 13% for motor insurance in the UK, and Buy Miles, I believe, is sustained below 4%. So that's really good going for them in that market. I think Flood Flash are kind of an out-of-the-box trailblazer for connected insurance. They literally use a connected device to, they attach it to the building of their commercial clients in the UK for a flood parametric insurance. So that there's actually an objective source of information out there that says, okay, flood water's got to this level. I wanted to pay out of X when it got to that level, and I'm going to get that payout now within, say, 48 hours, as opposed to waiting for a hydrologist and months of legal work to get a claims payment in some other jurisdictions. There are a couple of examples that come to mind.
Yeah, all right. Okay, I'll go next. It's funny because we're just hearing you speak. Maybe I have a too harsh a test on what good looks like. Because I definitely think, I definitely think the pace of change in the organization, in the industry now, particularly in the Insurtech space, is really, really exciting. I've seen some, MGAs, present company included, who are doing fantastic things. I think the real test will come, when they start to scale, when they start to have to sort of demonstrate, as you said, Simon, that pathway to profit or that profitability. Because certainly some of the folks you mentioned in the US, despite their scale, are still to get there. So really, for me, success is not only sort of when you nail the value proposition, not only you growing and bringing on new customers and getting really sort of strong feedback, but you've got a really sort of solid carrier relationships. You've got that pathway to profit. And you've built something that can be sort of some sort of sustainable proposition in market, right? You've got something clear that wins. And to be honest, if I'm sort of quite harsh, I think we're at the early days yet, because I think a lot of these Insurtech, a lot of these incumbents who are starting to have a look at this, it's got to get through the cycle. We've got to sort of see it scale. and we've got to sort of see that sustained over time. So it's probably a bit too early to tell, is a way to summarize my thinking. The one company that I have taken a bit of an interest in recently, it's not a venture actually, it's an incumbent, a 200-year-old French insurer by the name of Wacom, so WAKM, KAM if you're looking at it. This is a sort of, as I said, a 200-year-old insurer. It used to be called Le Parisien. They decided fairly recently to pivot their whole insurance company around creating a digital platform, and now they're servicing a significant number of the innovative startups, MGAs, distribution, I guess, ecosystem orchestrators, if you like. So the Revoluts and the neobanks, the e-commerce, and they're really sort of starting to build some pretty impressive connected insurance propositions, but it's all built around partnership, right? And their platform has been built in a way that allows them to best serve partners. So build unique propositions, onboard them quickly, support distribution, and they're working with a lot of companies that many incumbents were just too scared or were just not well educated enough to work with, and that's sort of opening up a lot of doors. Now they're still small for an incumbent, but just the guts and the sort of I guess the creativity behind their shift in business model is something that's really, really exciting, and I think they're sort of laying the foundations from an incumbent's perspective around how to work with startups and how to do it really well. And certainly one that we'll be keeping an eye on.
Actually, it's interesting to say that, James, because they're on my list, Wacom, in terms of folks that I think when you look around the world of, I think partnership's been a really nice theme, right, of today, like how important partnership is. And you touched on it there with Wacom, and obviously I've done a bunch of reading around how they engage with digital ecosystem partners as an incumbent. And they've got a really kind of structured approach, which is actually democratized across the business. And so when opportunities come in, they're then kind of pulled together, like shared with a really broad range of the business. They're then kind of business cases are pulled together. They're then presented back into the business to get kind of passed through. Then they kind of engage on how do we deliver the first POC? What's the size of the opportunity? And so they've got a really good structured partnership approach to how to kind of both kind of, I suppose, engage, build, and then launch new digital ecosystem partners. And so I think they're definitely someone that, to Dr. James's point, incumbents can look at in terms of folks that have got showing a really good path, I suppose. And then I guess when you flip that on its head and go, okay, where are the opportunities? Like where do we kind of, there's folks obviously doing really well, and then where do we think there's opportunities to build kind of solution, to build those partnerships? And obviously kind of for us, we think kind of that the enabler, the middleware is where there's a really big opportunity. And so how can you, we've spoken a bunch today about the complexity of being able to deliver these new partnerships and having the kind of technology and people to do that. We think there's a really good opportunity to be the enabler of that. There's how can you build the technology and the people that have I suppose the flexibility and the adaptability to deliver new use cases into market very quickly. And so I guess my core thinking there is kind of middleware and being an enabler is going to be a really key core opportunity in the next kind of 5 to 10 years for sure.
Excellent. Thank you all. We are going to move on to question time now. So Vanessa, feel free to open up audio for live questions if people would like to ask them live. I know that there are some questions in the chat here, which I'm going to start with. Danny, who's been a keen listener here, Danny Wood, by the looks of it, and lots of questions, which is great. So one of the questions here is around, he has essentially said that connected insurance is an idea or a business philosophy at this stage, but are there examples of apps or software that are already good examples of this? And perhaps you've sort of touched on that in that last question there. Did any of you have anything to add to that at all?
Yeah, I mean, we see solutions that are in the market around the world that are tangible examples that are generating revenue and so on. So yeah, we mentioned Flood Flash, Buy Miles, one of the more quirky, interesting ones. There's a company out of the Netherlands. They partnered with the Lloyd's team, and they put an IoT device in shipping containers that's got it generates its own energy, so it doesn't run out of batteries or anything. And basically, it's got a myriad of sensors in there, including temperature and humidity and lots of other things that will help to be able to provide data inputs on the environment and therefore the status of the goods that it's being transported. And then if certain conditions happen, it can alert to treat it, but often it can't be treated, and then it will just trigger a parametric payout. So yeah, there's a quirky example of tangible value that's been generated now.
Thanks, Simon. Actually missed a previous question there as well, and this one is actually around insurance brokers. So it again can be for anyone. Nigel perhaps touched on it. Do you see a future without insurance brokers, or how complex do you see connected insurance actually getting? So in 2030, what sort of complex insurance sectors could it be taking on? So there's a few different elements to that question there, but perhaps starting with that first one about insurance brokers.
Yeah, happy to jump in there. And it's a really good question. And I think a bunch of the, I guess, early folks out the gate that were direct to consumer kind of touted the death of the broker a long time ago. And I think that's proved it not to be the case, in at least now for sure. And I think about what a broker in terms of what they do today. I think their role will evolve. I think they're kind of how they kind of interact with customers today and how they kind of collect information and write quotes and speak to underwriters, etc. And that very much be a seller of a policy. I can see that role very much evolving more to be much more advisory and much less transactional. And so I don't think brokers specifically will disappear. I think they'll move up the value chain to more complex, and I think they'll be able to manage a lot more risks individually. So rather than being able to manage, I don't know, a portfolio of 150 clients, they could manage a portfolio of 1,000 because they have all the inbound data that can help them inform their customer of a changing risk or something that they've seen changing in the world, because of maybe a large business CEO doesn't want to kind of look at it themselves all of the time, and so they have someone that can advise them on that. And so I think the role will just continue to change. I don't think they'll be extinguished. I think their role will change to become more advisory and less transactional.
Yeah, I agree with that. I think building on that, I think if we come back to the customer, there are customers who always want advice, and I think a lot of that advice isn't, perhaps in the future a lot of that could be codified, and the sensor data can turn that into something that is trusted and really meaningful. But really, I completely agree with Nigel. I think when the Insurtech wave started, that was one of the, I guess, low-hanging fruit theories that you could digitize and potentially for some of the commodity lines of business that are actually unprofitable for brokers a lot of the time. That's certainly starting to happen. But I think it'll be more around brokers really sort of sharpening their value proposition, having an equal understanding of the data and the technology, and really being able to focus their attentions on truly understanding and building a relationship with the customer, and less about some of the more menial tasks behind the scenes, really sort of freeing themselves up. So, but I think there's definitely going to be a role.
Yeah, my quick spin on it is consistent with what you're saying. I think one of the key principles that customers these days value, and therefore is a key part of the startup playbook, is transparency, and transparency on friction costs. So I think what's happening is as these new entrants come in and there's new products coming to market, that value this transparency. What's happening is it's looking at the value chain and working out, okay, well, how can we generate the product and the service for the customer, and be transparent about the friction that's been incurred the whole way. And it's been pretty obvious that some of the cluster groups have been championing for commissions and so on for a long time, upward pressure on commissions, but I guess it's a good check right now in the interest of transparency to make sure that the value being generated in that part of the value chain is aligned with the friction cost. So, for example, if you look at risk exposure or the risk on a scale of 1 to 10, the more vanilla risks, maybe you don't need that much advice. So maybe you don't need to incur 30% comms to get it to market through a broker. So brokers, offer significant value. I was a broker for 10 years, I think, and whether advisory services comes from a human or technology in 50 years, who knows, but advice is quite important, but less so for the vanilla lines of risk, I guess.
And maybe just extending the second part to that question, if we had a crystal ball in 2030, what do we see, I guess, connected insurance looking like, or potentially having an impact on? If anyone wants to have a go at that.
I can say one thing. Sorry, Nigel. I guess the one thing. So that's a huge question. I'm happy to sort of check in with Dan offline around that, because that could go many places. But one of the things that's sort of coming back for me is, particularly for the commodity lines of business, I see insurance as being something that is almost invisible, if that makes sense. So, whether it's through other platforms and then sort of embedded insurance where it's just, with something you buy, or it's part of another platform you transact through or live through. I think there's going to be a lot less sort of proactive decision making around, what insurance proposition you want, and going out and actually, having to go through this fairly odorous task of getting it. I think one of the things we're exploring is that it's just going to be there. It's going to be understood. It's going to be transparent. It's going to be really slick, but it just happens. And it sounds a bit wishy-washy and a bit sort of, maybe a bit cliched a little bit, but I think certainly some of the things that we're playing with in the risk management space, say with MITI, or I know Nigel's looking at it, is basically to, if the data's doing its thing and the technology's there, then there's no reason why it just can't sit in the background and operate. It's a small business, right? If you've got workers' comp and you're hiring new people, rather than sort of have to fill in new things or jump a range in the underwriting, the way the business is underwritten, there's no reason why that feed can't be taken off your recruitment system or off your accounting system and automatically updates your policy and your premium changes next month, right? To reflect that. So it's sort of things like that where I just see it is happening in the background, and I think that's one thing that we can sort of anchor on, that is probably going to happen. Then there's all these other sorts of scenarios, but I won't go down there because we don't probably have that time.
I think and just to extend to that, I think it speaks, we mentioned a little bit earlier on about the number of connected devices. And I think if we think about it in terms of like us moving through a day, and like our connected devices are connected to every kind of part of our like kind of daily life, and how insurance sits on that. And so you walk out your front door and your kind of car insurance switches on as you sit down. You choose the route to move. You choose the route you're going to drive to work, and your underwriting, the route you choose, the underwriting changes, and your policy goes up 3 points. But it's also your life insurance policy, because you're going on a highway versus a B road. Like therefore, like your kind of life insurance policy clicks up a little bit because you're traveling on highways, not on kind of small roads, for example. And then when you get into work and you bought some new tools, your tool insurance for your small business is automatically updated to connect to the for the tools that you've just purchased. So when they've left them overnight at your kind of at the work site, they're protected. And so I guess just when you start thinking about it like that, in terms of you live in a connected world, and insurance as a risk protector is connected to all of your movements, then all of a sudden your eyes can really open up around to potential use cases. So I think to James's point, becomes a service that sits in the background that connects to all the data points that you're creating every day.
Yeah, we've got a thought out thesis on embedded insurance, and I agree with all of that. It'll be more like cheese on your hamburger that you can't separate, as opposed to, do you want fries with that, I think is a simple way to try and put it. But yeah, I agree 100%. The only other comment I'd make is, I think one notable shift that may happen over the next 8 years to 2030 is I think the insurance industry will be inbound to the consumer, as opposed to the consumer having to go outbound. So at the moment, the consumer has to go out with their data and put their information into multiple quote systems and so on and so on. So I think when we have a system, especially with consumer data rights, whereby a third party stores that data, and all the consumer has to do is maintain through, that'll be somewhat automated and somewhat manual, their risk profile. I think the insurance industry will ping the consumer with different offers at certain times throughout the policy period, as opposed to the insurer having to do all the legwork. I think that's one market shift that'll happen.
So I think a lot of that commentary revolves around seeing insurance as a lot more frictionless in the next decade or so. So let's all hope that that is certainly the case. Another question here around where most insurance companies are located or where they're coming from, and is Silicon Valley still the epicenter of Insurtech technology or insurance technology?
That's a good question. I reckon James will probably have a good view on this. I don't know, or Simon maybe.
Yeah, it certainly is. It's definitely the number one startup ecosystem in the world, and will continue to be so in perpetuity, I guess. In saying that, it can be expensive to partner, or to actually, from an investor point of view, because there's so much money around there. It's a lot of competition with venture money. But yeah, it's the number one ecosystem. Sydney punches above its weight in Southeast Asia. We've got biggest finance sector in terms of our share of GDP compared to Southeast Asia, even Hong Kong and Singapore. So we punch above our weight in in fintech and also in insurtech. In this region, we see from Australia alone 150 pitch decks from early stage in insurtechs, which is a number that may surprise some people. So there's a lot of insurtech founders looking to come to market in Australia, but there's also a lot of, as we're starting to see, a lot of founders from other verticals who have been successful, exited from like an agri-tech or a fintech or some other tech business that are looking to the insurance industry, knowing that it's one of the last industries to be disrupted. The barriers are now lowered for various reasons, and they can apply their doctorate in AI or whatever quirky climate science degree they have to achieve some value in an insurtech startup, which is quite exciting as well.
Yeah, I think from what we're seeing is the Silicon Valley, or California more broadly, is definitely still a hotbed, particularly in sort of well, more broadly for innovation. But there is still there is a strong insurtech fintech presence there. I think what we are seeing though is, we're engaged in some potential investments that hopefully we'll announce soon. I think one's in Silicon Valley, two are in New York, and so two's in New York, one's in London. So there is definitely a correlation to the sort of size of the financial hub. So outside of Silicon Valley, so we're seeing sort of New York, Boston, Chicago, a little bit in the US, London, sort of Singapore, Hong Kong, and sort of building on what Simon said, definitely a growing presence here in Australia, a little bit in New Zealand too, which is really, really exciting. I think COVID has actually been quite interesting, the fact now that we're speaking to founders out of Kansas, out of Iowa, out of all these sorts of parts of the world, obviously Perth a little bit too, right? And so there's definitely I think whether it sort of was happening before COVID or COVID sort of instigated, there's definitely there's less of a need to be in Silicon Valley. If I'm honest, I think it's helpful, but I think there's less of a need to be in Silicon Valley. I think technology has brought us together, but yeah, it's interesting. There's certainly a lot of activity happening outside of that place.
I think Austin, Texas is exploding based on exactly what you're saying there. Just everyone's getting out of the valley; it's too expensive, and that, and Ohio, and there's a few other places that are exploding.
Thanks. And I think we've got time for one last question here, which suggests that it could be for Simon. Can you give a rough idea of how many insurance companies are partnering up with insurtech types of organizations, or is what James and QBE are doing still quite rare?
Yeah, that's a good question. So, I mean, in Australia, I think I've got a bookmark on my Chrome browser that is to all the APRA-regulated insurers, and we've got varying relationships with the different APRA-regulated insurers just based on, I guess, their level of proactivity in partnering. I think there's no doubt that QBE are kind of leading the way in many ways, given their experience in partnering and being able to do it effectively, not just from their point of view, but from this being proactive and favourable for the startup as well. There's certainly a lot that do the tire kicking. We'll go and we'll sit next to founders, and I've been quite frank in this discussion, obviously. sitting next to the founders, and we'll pitch around the boardroom to their executives or whatever. And yeah, I mean, it's fair enough. Like they need to do a bit of Insurtech kind of investigations and so on to understand what's at play and what's involved, and dip their toe in and understand it a little bit. But yeah, it's definitely, especially post Hayne Royal Commission, there's definitely probably only half a dozen risk capital binder agreements agreed every year at the moment. I'd have to say, so there's not a hell of a lot, but I think it's going in the right direction. And obviously Insurtech Australia, not-for-profit, is doing a lot of work there to help this kind of drive forward.
I think globally, just to bring sort of bit on what Simon was saying, I think the vast majority of insurance companies, particularly the larger ones, are doing this. It's sometimes quite difficult to tell because some, like Kiwi, have a public facing part of the business that like Kiwi Ventures that has a brand in it, and it is doing that and talks quite freely in market about it. Some other companies have programs that are a lot larger than ours, and don't say a word, and it's very difficult to understand what they're doing because obviously a lot of it's private information, and on the startup's website you tend to get the same logos sort of there anyway, so it's hard to understand, and really you've got to take that with a bit of a pinch of salt. But I mean, some of the global, the behemoths globally are managing now over $1 billion in venture asset, right, which is huge for an industry that had virtually no startup exposure sort of 10 years ago, is now having funds, internal funds that are managing over €1 billion or $1 billion. It's huge, and so I definitely think the vast majority are doing something, whether or not it's public and you can read about it a lot. And then building on Simon's point, some people do it for the theatre and for the halo effect to their brand, and they're the tire kickers, they're the companies that probably don't quite understand what it takes to work with a startup and sort of the longer term perspective that's required. But they will learn, and I think they'll pick that up and recognise how important it is to any sort of future strategy, and we'll see more and more participation from the industry and the incumbent players.
Yeah, and I'll just build to that from a startup perspective, I suppose, looking at both the kind of local market and international market. I think just by nature of there being kind of few APRA-regulated entities here, it's just like the pool is smaller here, whereas when you look in the UK, US specifically, I think interesting that what James mentioned around COVID and kind of VCs, video conferences allowing you to have conversations much more easily. Like we've seen it from in kind of for our own experience, having conversations with thousands. The pool is thousands in the UK and the US in terms of kind of underwriters and carriers that you can work with, and those kind of partnerships being much more readily available, accessible, and for founders kind of in this part of the world to access kind of Asia, the European market and the US market is very much opening up. And I think the path to be able to do that and partner into those localities is kind of being trodden, and I think you're going to see a bunch more companies from here, from Australia, kind of raising their heads in those other national markets.
Great, thank you all. And I think, just adding to that, I think it is quite rare to find an insurer these days anywhere globally that isn't at least exploring partnering with Insurtech organizations in some way, shape or form. They're all at varying degrees of maturity, obviously, in where they're at in actually achieving that. So thank you for all those questions. We have run out of time, and I'd like to thank all the attendees for joining us today. I'd also like to really thank Simon, James and Nigel for sharing all your intel and knowledge with the attendees today as well. Thanks to Canopy, of course, and we're really looking forward to the next roundtable. Enjoy the rest of the day.
Thanks, everybody.
Thanks for having us. Cheers.